Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Mike Swanson, editor of WallStreetWindow.com. Welcome back to the show, Mike.
Oh, it's great to talk with you.
Mike, it would be, I know housing starts, at least in Canada, are at a record high, the highest since the early 70s when they started keeping stats. I'm sure it's the same situation in the U.S., but lumber prices are not making that new house you plan to build very affordable, is it?
No, definitely not. The cost of materials is going up. In fact, you mentioned lumber, and as of yesterday, the futures contract on lumber hit a 52-week high, trading at $1,200. And in May, it was at $300. So we're talking about a price that's gone up 4 times in value. And the reality is that commodities across the board, really since April, but that rally is picking up speed. It's not peaked out and going down at all. The Commodity Research Bureau Index, which is a basket of just about all the commodities. It made a new 52-week high yesterday. Also, we've mentioned in the past on your show the agriculture ETF DBA, which I own a position in. It's making a new high today as we speak. Also, so commodity across the board, most commodities have doubled in price from where they were a year ago. And to me, I believe this is just the start of a move that represents a bull market that's going to last for years. And the reason I believe that is that the commodity complex as a whole was in a bear market from 2011 to its final bottom last year in April. The DBA ETF made a new all-time low last year in April. Energy prices, the price of oil, actually went negative for a very short amount of time. So we saw the stock market crash last year. Commodities went down with it, and that did cause extreme low valuations in some stocks, but a secular bottom in commodities. Now, straight up, month after month or double every single year or something like that. But I do think they're in a position to go up for at least 5 years, perhaps 10. And we're now starting to see the effects of that when it comes to inflation. Since we last spoke, the U.S. government released its March CPI data, which showed a 2.6% annualized growth rate in consumer prices in the United States. Meanwhile, the yield on the 10-year Treasury bond is around 1.6%. This means if you buy Treasury bonds, you're going to lose money on the value of the money compared to the rate of inflation, guaranteed losses. So this is a big element defining investing in the financial markets, that bonds, because interest rates are so low, you're guaranteed basically to lose money unless you buy extremely risky junk bonds. It's making the bond market not a good place to invest. While it's traditionally been a safe haven for American investors since 1980, most investment advisors will tell their clients, put half your money in bonds, half your money in stocks, because bonds always go up. And that had been the case until perhaps around August, when bonds started to go down in value in the stock market. For the most part, has been fine. There's some now weakness in some parts of the market, the technology stocks, since February. But, there was a troubling time because the NASDAQ pulled back about 15% and bonds fell at the same time when they're supposed to do the opposite. But those who say bonds always go up, they only look at what happened since 1980. They don't look at the 1970s when bonds went down. So the idea that it's always a safe haven historically is false, and it's proving that that trend is false again. And I think that's going to be one of the defining stories again over the next 5 or 10 years. So it's another reason I think commodities are a place for people to be with a portion of their money when bonds don't work so well anymore.
We'll have more with Mike Swanson right after this.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Welcome back. We're speaking with Mike Swanson. Mike, one of the major U.S. banks said a couple of weeks ago that small cap stocks, the Russell 2000, is the place to be. And they say it won't just be growing for the next year or two. They say it will go on for decades. I don't know how accurate J.P. Morgan forecasts are. They've never met their gold targets, but maybe they're right about this.
Well, I actually, on this point, at the way things look to me right now, I would disagree with them, because if we look at the Russell 2000 index, and there's an ETF IWM that tracks it if people want to use that, it's actually starting to lag the S&P 500 and the Dow. It's been doing this since February. There's a small cap ETF IWC that has the same exact chart pattern. And I think what's really going on is since February, there's been a rotation out of stocks that have been among the best performing stocks last year into things that are perceived to benefit as the economy picks back up, and also commodity-related stocks and banks and so forth. A rotation out of the really popular stocks like Tesla, Apple, Square. There's an ETF ARC that invests in many of these sort of stocks. So you can use that to get an idea of what I'm talking about. But all these things did great last year, and then in February they dropped substantially, and then bounced, while the S&P 500 made a new 52-week high just last week, and so did the Dow. Many of these stocks haven't even taken back half their losses and are trading weak again this week. So what I believe is actually happening is there's a great rotation out of a lot of the past winners and into stuff that wasn't going up as much last year or is perceived to be positioned for an earnings boost this summer. And the Russell 2000 is, I think, trading weaker than the S&P and Dow, partially because of this. I'm not sure, though, when it comes to the Russell, this is a trend that's going to last for weeks, where it's trading weaker than the Dow and S&P, or just a few months. Excuse me, if this is, the weakness is going to continue for weeks or months, I really don't know. But what is clear to me is that when it comes to sectors this year to date, while the NASDAQ is, the ARC ETF is down for the year, the sector's up. Construction, which kind of goes back to you were mentioning real estate at the beginning, but real estate ETFs in stocks are also doing great. The RWR ETF, which is a REIT ETF, is making a new high, 52-week high today, just as we're speaking, while the NASDAQ is down. And I think this is the sort of stuff that's going to continue. Retail stores are outperforming the market this year. So I would tell people to look for, when it comes to stocks, sectors that are, leading this year that weren't leading last year, and avoid things that fell a lot in February and have put on weak bounces and haven't made a new high this month, while you've seen the S&P and Dow do it. I would get out of stocks like that. To name one, Tesla is one to avoid. Peloton is one to flee, in fact, because that stock, for example, is at 104. It was at 170 in February, so it's way off the 52-week high. It's below the 150 and 200-day moving average. And the company has been exposed for selling risky products. It sells these treadmills that were all a massive fad last year because some people were scared to go out of their house and they wanted to still exercise. But now it's been revealed that some of these treadmills will malfunction and kill children that are on them. A child has been killed as a result of this treadmill device that malfunctioned. Another one I'd say avoid is Zoom. Zoom was one of the memes and themes of last year. Everyone's got to get on a Zoom call, have their meetings, and it's probably going to continue. But it became a mania in speculating in that stock. It went to 600 in October, and now it's trading at 325, down 50% from the high. And it's lagging the market. When the S&P and Dow make new highs, this stock barely even went up this month. It's a stock to avoid. So I would tell people, look, if you got some of these fad stocks that are off the highs and still acting sluggish, get out of them and get into new things. And something that isn't new to me, isn't new to you or most of your audience, but is new to most Americans, especially those that open up a Robinhood account to trade for the first time, is gold and silver. Get in gold and silver because gold made a double bottom last month, went through 1750, which was the high last month, and the GDX did something similar, went through 35. The GDX is the gold stock ETF, went through 35 last week, now trading at 36. I believe mining stocks in gold and silver are positioned to rally at least into the summer. I'm looking for gold to attack the 2000 level, which will create giant moves, sizable moves in these mining stocks. So again, you want a simple pair trade where you go long something and short something, go long GDX, short the ARK ETF, and I think that would be a good so-called pair trade to make.
We'll have more with Mike Swanson right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Mike Swanson. Mike, what's going on with the junior miners?
Well, they're one thing about them. So in August, the price of gold peaked out. That's the last peak it made, around $20.75, and it slid down to $16.75 in March. After which it made a double bottom, and I believe it's starting to trend up and start a new rally. And when gold, silver, and mining stocks begin a new rally, typically what happens is the big cap mining stocks will get a bid first. And these juniors can continue to trade sideways as a whole, and lag the action in the larger mining stocks. And then once you get like past the first third of a rally, then they'll start to move and pick up, and some of them will completely take off and explode. So that's what I'm expecting is going to play out again. And today, Newmont, for example, is up 2%. And if I look at one junior miner that I'm watching, it's up 1%. And so I think that's kind of, the type of thing that's typical. But I would say, that's going to change, probably, let's say in a month or two, where these juniors will start to move and actually outperform the big cap mining stocks. But one positive thing about these junior mining stocks is even though they did pull back, from August to really last month, along with big cap mining stocks, relatively speaking, compared to last periods of corrections, they didn't fall that much, for what, had happened in the past. And most of them have been going sideways for 2 months now, and you can draw, support levels in them and look at the highs of last March as a potential resistance level, and most of them are trading in between. For me, what that means is you still got a great entry point in most of these junior mining stocks. They haven't really taken off yet, and I think the risks of more declines in them is pretty much eliminated with the double bottom in gold and the start of a rally in the larger mining stocks. So I would say that it's a buying opportunity in them. If you want to get involved in that sector, though, really, I believe the way to do it is not to buy one junior mining stock, but to buy several of them, buy 10 of them or even more, because you want to spread out in a bunch of them, because frankly, it's very difficult to predict which one is going to be the best one to buy. It just is. So the thing to do is buy a bunch of them, and you'll get a couple of giant winners, and the rest of them will kind of trade together. So that's how I play the sector, or any sector for that matter, and that's basically what I'm doing myself. And that's a strategy that's worked in the past. For me, is when you hit it in the junior mining space, you can get a stock that goes from, makes a 10-to-1 gain, while, go up 30% or just double, and so forth. You'll get a few that really, really take off, and that can result in a big overall return, in a portfolio.
Mike, thank you so much for chatting with us.
Okay, yeah, great to talk to you.
My guest has been Mike Swanson, editor of WallStreetWindow.com. If you have any questions for Mike or any of our other guests, you can send them to info@HowStreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.